Right now, the government is quietly considering changes to council tax that could fundamentally reshape how much you pay to own your home. The government expects to raise £4 billion, but who will the losers be? When downsizing your main property, most people in the process expect to also reduce their monthly spending. It's something that many planning to retire will have thought was a given. If the rumoured council tax changes are introduced this autumn budget, that may not be such a reliable assumption to make. Here's what's happening behind the scenes, and why you need to pay attention now, before decisions get locked in. If you want to get the latest news on the hidden tax shifts and the fiscal mechanisms reshaping property wealth, retirement planning and inheritance, subscribe now. We summarize the news, speculation and policy changes, helping you to stay informed and cut through the noise. When you pay council tax, you're paying based on a property valuation that was done in 1991. Yes, you read that right. 1991. Think about that for a second. Your house has probably tripled or quadrupled in value since then. The average property in the UK is worth roughly £280,000 today. But your council tax band, the one determining how much you pay, is based on what your home was worth when John Major was Prime Minister. A Band H property, the highest current band, is charged based on values above £320,000 from 1991. Adjusted for inflation, that's roughly equivalent to £1.5 million today. Yet a property worth £3 million or £5 million still pays exactly the same amount as that £1.5 million house. In fact, Band H properties pay only twice what a Band D property pays, despite often being worth 10 times as much. The Institute for Fiscal Studies has looked at this and basically said this is out of date and arbitrary. And when a think tank like that is using words like out of date, it means the political wheels are already turning. There's a fiscal problem nobody really wants to talk about. The government needs revenue. After the 2024 budget, there was a £22 billion hole in the public finances, larger than anyone expected. When you're facing numbers like that, old taxes start looking attractive again. Council tax reform is one of the easiest wins on the table. Why? Because it affects property owners, who are generally assumed to have deeper pockets than renters. And politically, it's easier to change a tax that hasn't been revalued in 34 years than it is to raise income tax or VAT, which the current government has ruled out. So the speculation isn't random noise. It's coming from serious analysts and think tanks who track government revenue sources. According to the Institute for Fiscal Studies, different reform options raise very different amounts. Simply adding new bands for the most expensive properties, say at £2 million, £4 million and £8 million, raises roughly £270 million a year. But doubling the tax on bands G and H, which affects about 4% of properties, could raise £4.2 billion by 2029 to 30. That's where the real money is. That's the kind of figure that gets attention in a tight fiscal environment. Let me be clear, nothing has been officially announced, but the speculation has narrowed down to a few realistic options, and it's worth understanding what each would mean for you. The first option is splitting Band H into multiple bands. So instead of just having Band H, you'd have H1, H2, H3 and H4. The lower bands would keep a similar multiplier to what they have now, but the higher bands would see increases. A property worth £2.5 million would pay more than it does now, with the gap widening at each tier. The second option, which some analysts favour and which raises more revenue, is simply doubling the council tax on bands G and H. That's straightforward. You pay twice as much. This would mean roughly 4% of properties seeing sharp increases, mainly in London and the South East. The third option, and this is where it gets serious, is a complete overhaul. Wales has already started moving down this path. You could see council tax replaced with a wealth tax that applies annually to the market value of your property, updated periodically. Now, here's where it matters for your retirement planning. Any of these changes would increase the annual costs of owning an expensive property, not once, every single year. If you're a 55-year-old who's counting on selling your £800,000 house to fund your retirement, you need to factor in higher ongoing costs before that point, or lower asset value if you're looking to downsize. Let's talk about what's actually at stake. If you're in a Band E, F, G or H property, which increasingly means any homeowner in the southeast or major metropolitan areas, you're already paying a disproportionate amount relative to your 1991 valuation. Let me give you actual numbers from 2024. The average Band D council tax across England was £1,893 for the year. But if you're in London, in a higher band, you're paying significantly more. And these bills went up by around 5% year on year during 2024 to 2025 in many areas, just from incremental increases. Now imagine your council tax bill goes up by another 20%, 30%, or 50% because the government finally revalues your property. And then imagine it keeps going up year on year because the system is now flexible instead of frozen. That's compounding against your retirement plans. For someone planning to retire in 10 years, every £2,000 to £3,000 a year in additional council tax is £20,000 to £30,000 you're not taking out of the property. If you were relying on that cash to help fund your retirement alongside the capital gain, you're now starting from a smaller position. And here's the thing, everyone else in your situation is feeling the same pressure. The rental market sees higher property taxes, and landlords adjust rents upward to compensate. The housing market sees higher ownership costs, and properties become slightly less attractive to buyers, or prices adjust downward to reflect the increased burden. Your asset, which you thought was a reliable retirement vehicle, just became less reliable in multiple ways. The word trap might sound dramatic, but here's why it fits. If you're a homeowner and you do nothing, you're betting that council tax reform won't happen. That's a gamble with your retirement. But if you try to get ahead of it, if you try to sell now to lock in current valuations and avoid potential tax increases, you're facing stamp duty costs, transaction costs, and all the friction that comes with moving house. The government knows this. They're hoping some homeowners will do nothing out of inertia or hope. Others will try to sell and face a wave of stamp duty and transaction taxes. Either way, they're capturing value. It's not quite a trap in the sense that it's illegal or hidden. It's a trap because the incentive structure makes every option feel mediocre. Here's the straightforward advice. If you're within 5 to 10 years of retirement and you're holding a property significantly above the median value for your area, this is worth thinking about now, not in 2 years. You don't need to panic sell tomorrow, but you do need to honestly model 3 scenarios for your retirement. One where council tax stays the same, one where it increases modestly, and one where there's significant reform. Talk to an accountant or financial planner about the specifics, because the numbers are different if you own outright versus if you have a mortgage. And if you're in your 50s and thinking about downsizing anyway, adding this to your timeline might make sense. The other thing is understanding what's actually being proposed. Keep an eye on official statements from the Treasury. The rumour mill runs wild before every budget, but actual announcements narrow things down fast. You want to be informed, not just anxious. Lastly, and this matters, if you're a landlord or you own multiple properties, this could hit you harder. Additional properties are already facing higher council tax in many areas, and if reform comes, it might be targeted at higher value homes specifically. This isn't just about council tax. This is about the government running out of easy places to raise money. When that happens, they look at what assets people are holding and ask, how much are we leaving on the table here? Pension reforms have already happened. Capital gains, tax changes already happened. Inheritance tax reforms on farming estates already happened. Council tax reform isn't a wild speculation. It's the next logical area where politicians see potential revenue. Your job is to not get caught flat-footed when it arrives. That means thinking about it now, even if nothing's been officially announced. Look, a lot of this is speculation, but it's educated speculation from tax analysts and policy experts who track this for a living. And historically, when multiple analysts start pointing at something as a potential revenue source, governments eventually listen. You own one of the most valuable things you've got in that house. You deserve to be thinking strategically about what's happening to the tax environment around that asset. Have you thought about how council tax reform might affect your plans? Do you think it's a just target for the greater good of the economy? Do you feel in control of your future plans? Let us know in the comments. No doubt, the conversation will continue after the budget and once we really know what the Chancellor has in store. If you found this breakdown helpful, don't forget to hit that like button and subscribe to Retirement Brief UK for more essential updates on the UK retirement landscape. We cover everything from changes to the property market, summarising news on legislation changes and market trends to practical advice for homeowners and investors. Ring the notification bell so you never miss an update that could affect your retirement planning decisions. Thanks for watching, and we'll see you in the next one.